Have you ever wondered what would happen if you put a chunk of money into the stock market and simply walked away? Let's conduct a thought experiment. Imagine it's the turn of the millennium. The year is 2000. You take $10,000, a significant sum of money, and you invest it all into a broad market index fund that tracks the S&P 500. You don't try to time the market. You don't pick individual stocks. You just buy the market and resolve to forget about it for the next quarter century. What would that initial investment look like now, on this day in March 12, 2026? This isn't just a story about numbers on a screen, it's a testament to the power of time, the virtue of patience, and the often underestimated force of compounding. Our story begins at a moment of peak optimism which, in market terms, is often a sign of impending danger. The year 2000 dawned with the S&P 500 trading near its all-time highs, fueled by an unprecedented mania for internet-related companies. Anything with a .com in its name was attracting billions regardless of business model or profitability. It was a classic speculative bubble. On January 1, 2000, our hypothetical investor puts $10,000 into an S&P 500 index fund. For a brief period things looked good, the index even ticked slightly higher in the first couple of months, but the foundation was made of sand, the tide was about to go out. The crash began in March 2000, and it wasn't a single-day event. It was a slow, grinding decline lasting over 2 years. The tech-heavy Nasdaq was the epicenter, losing nearly 80%. The S&P was diversified but not immune. Confidence evaporated. Companies once hailed as the future went bankrupt. A wave of selling cascaded through the market. The decline continued through 2001 into 2002. The September 11, 2001 attacks delivered another profound shock. Markets shut down temporarily and the downturn accelerated on reopening. Corporate accounting scandals at major companies like Enron, WorldCom further eroded investor trust and created pervasive gloom. By October 2002, the S&P had fallen nearly 50%. Our investors' $10,000 was now about $6,000. 2.5 years of patience resulted in a 40% loss. This is where most people panic and sell, locking in losses. The psychological pressure was enormous. Financial news channels were filled with stories of ruin. Neighbors who once bragged were now silent. To hold on required almost blind faith in America's resilience. It meant ignoring the deafening chorus of negativity and sticking to the plan. Our investor had forgotten about the account, that ignorance became an accidental but powerful form of discipline. After hitting its nadir in late 2002, the market began a slow and arduous climb back. The years from 2003 to 2007 were marked by steady economic growth, recovering corporate profits. The Federal Reserve kept interest rates low, encouraging borrowing and investment. The wounds from the .com bust began to heal. Cautious optimism returned. By end of 2004, the account was around 8,000. By 2006, it finally surpassed the original investment. By mid-2007, the S&P 500 had passed its 2000 peak. Our investors' portfolio, buoyed by market growth and reinvested dividends, was now roughly $14,000. But beneath this stability, a new, more dangerous bubble was inflating. Not tech, but housing. Low interest rates, lax lending standards, mortgage-backed securities. Prices for homes skyrocketed. Many took mortgages they couldn't afford, expecting easy refinances or quick sales. Banks bundled subprime mortgages and sold them worldwide, spreading the risk. The first tremors were felt in 2007. Payments reset to unaffordable levels, leading to defaults and foreclosures. Securities once considered safe suddenly became toxic and impossible to value. Financial institutions heavily exposed began reporting massive losses. Optimism evaporated, replaced by dread. The market was on the edge of a cliff. If the .com bust was a trial by fire, the great financial crisis of 2008 was a descent into the abyss. The intricate web of derivatives and securities acted as a transmission mechanism for panic. No one knew which banks were soluble. Credit markets froze. Even healthy companies couldn't get short-term loans for day-to-day operations. The global financial system, the circulatory system of the modern economy, was having a heart attack. The storm broke in September 2008. The U.S. government took over Fannie Mae and Freddie Mac. Then, Lehman Brothers filed for bankruptcy on September 15, 2008. The shockwave signaled no institution was too big to fail. The stock market went into a freefall. The Dow saw several of its largest single-day point drops in history. For our investor, gains vanished in weeks. crashing back through $10,000. Headlines: bank failures, government bailouts, TARP, dire predictions of a second Great Depression. The S&P hit bottom on March 9, 2009, down over 55% from its 2007 peak. Our investors' portfolio bottomed at about $5,500. After 9 years, the $10,000 was nearly cut in half. Famous commentators urged viewers to get out. Yet by doing nothing, not panic selling, our investor made the most important financial decision they never made. Just as despair peaked in early 2009, the market turned, not because news was good, but because the worst case had been priced in, and things were, less bad, fueled by unprecedented actions from the Federal Reserve, near-zero rates and quantitative easing. A newer orgus now briber damber over swapspor. Market was born. It started as a reluctant, skeptical climb. Many called it a bear market rally or a dead cat bounce. They were wrong. The recovery that began in March 2009 became one of the longest and strongest in history. By 2011, the portfolio recovered to 10,000. By early 2013, past the old highs. From there, new highs for years. Technology once again dominated. Apple, Google, now Alphabet, Amazon, Facebook, now Meta. This time as profitable global behemoths, corporate profits rebounded strongly. Companies returned capital through dividends and stock buybacks. Despite scares in 2011 and 2015, the uptrend proved resilient. By the end of 2019, the initial 10,000, after two 50% drawdowns, had grown to approximately 38,000. The most powerful returns often come during recovery phases. Those who sold near the 2009 bottom locked in losses and missed spectacular gains. Our passive investor, by staying in, captured the full power of the rebound and the long expansion that followed. Throughout this tumultuous journey, an unseen engine has been quietly working in the background, amplifying the returns of our investment. The reinvestment of dividends. When a company in the S&P 500 earns a profit, it can reinvest, pay down debt, buy back stock, or distribute a cash dividend. Our investor chose automatic reinvestment. Instead of cash every quarter, those dividends buy more shares. When prices are low, dividends buy more shares. Automatic dollar cost averaging. When markets recover, you own more shares than before, which then generate even more dividends. A virtuous feedback loop. Over 26 years, reinvesting systematically increases ownership. Taking dividends as cash leads to significantly lower returns. Each dividend-funded share becomes a new soldier, especially powerful when bought at bargain prices during downturns. Over long periods, reinvested dividends have sometimes accounted for as much as 40% of the S&P 500's total return. It's slow, steady, boring, the tortoise that wins the race. That steady drip really adds up over time. Just as the world settled into a new decade, the next once-in-a-generation crisis struck. In early 2020, COVID-19 swept the globe, bringing economies to a screeching halt. Governments imposed lockdowns, businesses closed, supply chains were thrown into chaos. The S&P 500 suffered its fastest bear market decline in history, more than 30% in just over a month. Our investors' portfolio, above 40,000, quickly lost more than 12,000. The fear rivaled 2008. The response was swift and massive. The Fed cut rates to zero, launched enormous asset purchases, and the US passed trillions in relief, a powerful backstop. After bottoming March 23, 2020, the S&P staged a remarkable V-shaped recovery, reclaiming all-time highs by August, the shortest bear market in history. For our investor, losses were erased and new records set. By the end of 2021, the account had soared past $50,000. 2022 brought inflation, rising rates, and geopolitics, a sharp downturn. But markets recovered through 2023 and into the following years. Markets suffer sudden shocks, but historically the diversified long-term trend rewards those who can endure the volatility. We have now traveled through 26 years of market history. We started at the peak of the dot-com bubble, endured a 2-year crash, and rode the recovery to a new peak in 2007. We plunged into the great financial crisis and saw our investment cut in half. Then we held on for the longest bull market, survived COVID's shocking drop, and its equally shocking recovery. We navigated inflation and rising rates. After all this drama, we arrive at today, March 12, 2026. With market growth and continuous dividend reinvestment, that $10,000 in an S&P 500 index fund would now be worth approximately $61,000. This is a total return of 510%, an annualized return of roughly 7.3%. Without reinvested dividends, the final value would be closer to $45,000. Roughly $16,000 came from reinvested dividends. The fuel of long-term returns. It's not a guarantee of future performance, but a powerful historical lesson, a testament to long-term growth of the American economy. The rewards for enduring volatility can be substantial. This 26-year journey offers several clear, actionable lessons. The first and most important: stay invested through the downturns. Selling near bottoms is catastrophic. It turns temporary paper losses into permanent ones. Patience isn't just a virtue, it's a prerequisite. Emotional discipline to hold on is what separates successful long-term investors. Second, harness compounding by reinvesting dividends. A huge portion of the $61,000 came from dividends. Set drip once, let the snowball grow. Third, focus on time in the market, not timing it. Our investor bought and held. Missing just a few best days can devastate returns. It proves that a simple strategy, executed with discipline, can produce extraordinary results. Start with a plan, diversify with an index fund, stay invested, let dividends compound. The most valuable asset isn't a stock tip or a clever strategy, it's time in the market. Right, time in the market. That is the ultimate lesson from our 2.5-decade journey.